It's a bit like the Wile E. Coyote in the cartoons having run off the edge of the cliff, his legs still going, but there's a delayed impact before the gravitational forces pull him back down to Earth again. Welcome to our mid-year outlook 2023, which we've titled Threading the Needle. This refers to the challenge that the central banks have trying to maintain a growth dynamic while at the same time bringing back still troublesome inflation towards their targets. There have been many cross-currents at work in the first half of the year. Notably, headline inflation has plunged as we had anticipated, but growth has been much more robust than we had thought. A banking crisis, a systemic banking crisis, was averted back in March, and the equity markets have taken heart to this despite the fact that we didn't get the policy pivot that many had been hoping for. Indeed, we see many equity markets now in bull market territory, up by more than 20% since the lows of last year. And as I noted, this has been against a backdrop where the central banks have not only spoken in hawkish terms, but have continued to ratchet rates ever higher. So what does the rest of the year have in store? Well, we suspect there's going to be problems ahead. We think that all these rate hikes will ultimately take their toll, and we think that it's a bit like the Wile E. Coyote in the cartoons having run off the edge of the cliff, his legs still going, but there's a delayed impact before the gravitational forces pull him back down to Earth again. Now, we're not expecting a horrible recession going forward. We are expecting Europe to remain in recession, and we think the US will enter recession towards the later months of this year as a function of the very penal impact that the massive rate hikes that we've seen ultimately have in the economies. Broadly speaking, the manufacturing sector is already in contractionary or recessionary territory worldwide. We're seeing global trade really come under significant pressure and contract. The service sector has held up well, the jobs market has been very robust, and we still have had excess savings from the pandemic being put to work. But we see that changing. The labour market, we look at leading indicators such as hours worked and overtime, the quit rate in the United States, which shows that people are less willing to jump ship for better terms, all suggest to us that the labour market is beginning to weaken. And remember, usually unemployment is at its very low level of the cycle before the recession begins to take hold. So again, it tends to lag somewhat. That's why we look at these leading indicators that I mentioned. In terms of excess savings, that also appears to be largely used up from our own research, but also some from the San Francisco Bank in the United States. All imply that actually a lot of that excess has been spent, and therefore there's going to be less firepower going forward. And indeed, we see in some parts of the world, including the US, the savings rate tick higher, which imply that consumers are becoming more circumspect in how they spend. When we look at the financial markets, there is no doubt these higher interest rates have impacted both the willingness and desire to lend. We've also seen the banking issues as well mean that the banks are less forthcoming in providing financing as well. Quite dramatically in both the United States and in Europe, we've seen the demand for credit really dry up quite considerably as the accessibility and the cost of that credit impacts the willingness of companies to take on credit to invest, needing to get a much higher return now that rates are higher as well. So what does this mean? Well, we suspect bankruptcies are going to be rising. We've raised our number for bankruptcies in the US to 7% for this year. Still low by historic recessionary levels, but nonetheless significantly higher than we've seen in the last few years. And there's no doubt we think that credit spreads are not reflecting all of these risks. So we think spreads for credit will be rising going forward. From an equity market perspective, there's very little risk premium baked in at all. Despite the fact that rates have gone up, multiples have expanded, which is somewhat unusual. And we look forward, we think that a lot of the covering of short positions that have helped drive equities higher in the first part of this year are beginning to wane. We suspect that sentiment will turn, and as margins come under more pressure and earnings come down, we think that these markets are looking extended and a pullback is likely. What about government bonds? Well, yields have moved up in recent weeks, but we suspect that as the inflation numbers continue to move lower, and as we think that the central banks will increasingly pause as the weaker growth and lower inflation numbers come through, we think that bond yields, government bond yields, will be grinding lower over the remaining part of the year. Now remember, you can read the full report in all its detail, as always, on zurich.com/MSME.